Hello financial fans, welcome back to another stock analysis. Today we'll be covering Realty Income Corporation stock ticker O. Realty Income Corporation, also known as the Monthly Dividend Company, is a publicly traded real estate investment trust, or REIT, that primarily acquires, owns and manages single-tenant commercial properties in the United States. The company focuses on acquiring freestanding single-tenant properties that are leased to creditworthy tenants in the retail, industrial and service sectors. Realty Income's business model is based on generating income from rental of properties, and it distributes a significant portion of its income to shareholders in the form of dividends. The company operates under a triple net lease structure where the tenants are responsible for paying property taxes, insurance and maintenance, which allows Realty Income to focus on acquiring and managing properties. The company has a diverse portfolio of properties which include retail stores, warehouses, distribution centers and other commercial properties. The company's tenants base is diverse and includes well-known companies in the various industries such as Walgreens Boots Alliance, Dollar General, and FedEx. Currently, they're sitting at a $42.1 billion market cap, and in 2021 they generated a revenue of $2.1 billion. Their dividend yield is currently sitting at 4.46%, and they pay out monthly dividends. 83% of their revenue comes from the retail sector, 15% from industry, and 2% are others. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from the margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from the margin of safety. The first two ratios that we'll be looking at are the EBIT growth and the margin growth. The EBIT has grown from $283 million in 2013 to $714 million in the trailing 12 months. The average growth in in EBIT during this period was 17%, meaning a 5% deduction from a margin of safety. The margin, however, has dropped, going from 55% in 2013 to 37.5% in the last trailing 12 months, meaning a 4% average margin decrease, which is a 5% increase in our margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have grown, going from $1.70 a share annually in 2011 to $2.97 a share annually in 2021. The average growth in dividends during this period was 5.5%, but since they're paying out monthly dividends, I've chosen that they still will be eligible for a 5% margin of safety deduction, seeing as it's very close to this annual dividend growth requirement. The payout ratio will not be taken in account, since REITs need to pay at least 90% of their taxable income as dividends, which would be red in our scale, which is not fair because REITs are required to do this, so we will be leaving this one out of the question. So the payout ratio will not be used. The final two ratios are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, you have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Realty Income, this is over 10 years, meaning a 1054% debt to EBITDA ratio, meaning a 5% increase in the margin of safety. The return on invested capital is sitting at a relatively small 2.86%, meaning no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Realty Income. The first valuation model that we'll be using is the price to funds from operations ratio. I've imported this ratio going from 2012 to 2021. The average ratio during this period was $19.02, and the trailing 12-month ratio is $17.32, which is a difference of 9.81%. This adjusted to the price of $67.10, we get a fair value out of this model of $73.68, which is this 9.81% upside. The second model that we'll be using is the dividend discount model. I've imported the yearly dividends going from 4 years ago to the current year. The average growth rate in dividends during this period was almost 3%. But I've expected a growth rate of 4%, seeing as this comes closer to the rates they have increased their dividends by prior to these 4 years ago. We'll be using a discount rate of 8% in this model, which leaves us with a dividend model price per share of $77.14. And with the current price of $67.10, we get an upside out of this model of $10.04, which is almost a 15% upside. The third model that we'll be using is the AFFO multiple valuation. AFFO stands for Adjusted Funds from Operations. In this model, we'll be looking at the price to AFFO ratio of similar companies to Realty Income, so we can determine the average ratio in the industry. In this case, this is 18.11, and the price to AFFO ratio for Realty Income is 17.34, which gives us a fair value of $70.06. With the current price of $67.10, here we get an upside of $2.96, which is a 4.41% upside. The final model that we'll be using to determine the intrinsic value of Realty Income is the net asset value. In this model, we'll be looking at the net operating income and projecting a growth rate that we foresee in the upcoming year. In this case, I've gone with 14%, which means the forward year NOI, which stands for net operating income, is $1.4 billion. Then we need to make an assumption of the capitalization rate of this net operating income, and I've gone with 2.25%, leaving us with a value of assets of $62.6 billion. All we have to do to get our net asset value is subtract the debt, which is $17.25 billion, and we get a net asset value of $45.4 billion. This divided by the amount of shares, which for Realty Income is 660 million shares, we get a net asset value price per share of $68.79, and with the current price of $67.10, we get an upside out of this model of 3%. Let's go look at the final overview of the valuation models next. Looking at our final overview, we've imported the share prices of the price to funds from operations, the discounted dividend model, the AFFO multiples valuation, and the net asset value share price, which leaves us with an average of $72.42. We have determined the margin of safety earlier using a standard margin of safety of 20%, adding 5% for the debt to EBITDA, deducting 5% for the EBIT growth, adding 5% for the margin growth, and deducting 5% for the dividend growth, leaving us with a margin of safety of 20%. Applying this margin of safety to our average, we get a fair value of $57.93, and with the current price of $67.10, we get a downside of 13.66%. Usually I would say, in this case, it's a sell, but since this company generates income and is purposely used for people in their portfolio to generate income, I've changed sell to hold. If there's any other dividend companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.